and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World headquarters in Bloomington, Minnesota. For those of you tuning in for the first time, Revenue Rocket is the world's premier M&A advisor to IT services companies. We are M&A people. With that, my partner Ryan's with me today. How you doing, Ryan?
Hey, Mike, I am doing well. And yeah, we are M&A people. I think part of what interests me in this career and profession, I think for you, Mike, you love giving back, and part of that is giving back some knowledge. So we try to tackle topics that serve the questions our customers are asking and what we're seeing on a weekly basis. And I literally just got off a phone call with an executive at a private equity firm who has multiple investments in the IT space. And the private equity firm is just asking the question of boy, what does buy side advisory look like? What is it? We haven't really done this before. And we work with our own internal deal teams, and we expect them to really produce results. But can we do a little bit more? Are there other ways to go out there? So, Mike, that really prompted me today to have this discussion with you on. I wanted to raise this up and ask the question, when does it make sense to do M&A? And why does it make sense, or when does it make sense to bring on an M&A advisor? I'd love to discuss that topic with you today, Mike. So let's just jump right in. Mike, why are people in the IT services space, and why are the most CEOs in this market, what makes them think about buying a company in the first place, and why should companies in general start thinking of utilizing mergers or an acquisition as a strategy for increased growth?
Well, part of the reason, Ryan, is that it helps you compress time, right? Certainly I think as most successful entrepreneurs in the IT services space go, there's a certain cadence of growth and profitability that their firm has. And, it takes time to continue to scale and grow a firm, right? And if your desire is to eventually exit an investment with a firm, which I think, many people that have started firms and even sponsors that sponsor firms like private equity firms and other investors, there are some buy and hold sort of investors, but many of them want to increase shareholder value and then ultimately exit and be able to capture that value. And along that journey, a way to sort of compress time to their goal is to do buy-side M&A, is to acquire firms that fit strategically, culturally, financially, so that they can get to their goals faster. And I think, certainly that's the business case behind M&A. That's at least one of them. I think certainly there's other opportunities too with accretive value, what we'll call EBITDA multiple accretion, where, a larger firm may trade at a higher multiple than a smaller firm. And if you can pull together and integrate some smaller firms into a larger firm, you'll be able to, gain some economies of scale there, typically take some cost out, as well as get to a higher multiple because you're larger and more attractive to a buyer up market.
Absolutely. And, we've also seen companies just looking to bring in an adjacency strategy to their market. And so sometimes you're filling product or service line gaps. Perhaps you're diversifying your service line overall. We've worked, for example, with companies that specialize in implementing one flavor of ERP and just adding another vendor to the mix. And so not only is it accretive to revenue and profit, which in this case it certainly is, but it also helps them bring diversity to the portfolio. Their customer portfolio starts to expand, and they start to fill in gaps. And I think one of the big things is when you're thinking about why you want to acquire and what does it take to get in that M&A mindset is really, Mike, what you mentioned, having that strategy first and making sure that's well defined. And before you think about any type of process, whether bringing on an advisor or just in-house, making sure that you've got your vision and your core focus really nailed down. And if that core focus includes expanding a geography, expanding a revenue, expanding a service line, that a tool in the toolkit starts to become buying other firms to fill those gaps and really live up to that vision for your 1 year, 3 year, and 10 year plans. If I flip that script, Mike, we get a lot of firms. We talk with some firms that are just starting out their journey. If I look at, hey, M&A can be very powerful for growing through buying other firms. When do you start to take a different look at that, and when should a CEO like not consider buying? When's it too early or misaligned with a company's strategy that someone should say, hey, maybe M&A is not the right play at this moment?
Well, I think you can't fix fundamentally, things that are broken in your business through M&A. I think a lot of people think that's a possibility. Like they go, oh, I'm great technically and I built a super business, but it doesn't grow very well. We don't really know how to go to market very well or sell. We get all of our business through word of mouth, and hey, maybe I can go buy a business that has a great sales guy. That model oftentimes doesn't work as well as you think it might, intuitively. Or I need to shore up my delivery function or my contact center function or my, fill in the blank, right? Back office function. That doesn't always, scratch the itch. I think it's critically important if someone's going to scale effectively through M&A to have a well-running business, one that runs organically, grows, knows how to market and sell, knows how to deliver, and is probably in the top quartile of both revenue growth and profit realization amongst its peers. It also has to have some scale, because you can certainly afford to buy much smaller firms, but and you can probably afford to take on the risk and the financial burden of buying a firm about half your size. We've certainly seen and helped clients buy firms as large as themselves, but it's more rare, and it's important to know sort of what you're acquiring, and ultimately, if you're going to be integrating that into your proven business model where you can get some efficiencies, that's a 1 + 1 = 3. So, I would say you need to be running pretty darn well organically. You need to be a leader amongst your peers for both revenue growth and profit realization. And you need to have some scale. You probably need to be, 10 million, at least 10 million in revenue, looking to do some tuck-ins and add-ons, and bigger is better, frankly, as you look to do M&A, because as you look down market from the view of a $10 million firm or a $15 million firm or a $20 million firm, firms that start to get too small tend to be not very mature financially. They tend to not have their processes completely figured out, or at least mostly figured out. And that makes it harder to get synergies. You may think, well, it might make it easier to get synergies if we implement all of our business, proven business processes and practices. But that approach to, that fixer-upper, hey, we're going to buy this firm and, kind of dial in our process, is oftentimes harder than you think. So I think you have to be a firm that runs really well, and one that's large enough to buy a firm of scale that has enough going on that, you know what you're getting.
Right. You have to have meaningful impact to the business. And that's why oftentimes, maybe your topic for a different podcast, but when a company is considering an acquisition, doing a small deal versus a big deal, it's still the same amount of work in many contexts. So oftentimes just finding off and buying the biggest company you can is the best way to do that. But yeah, I will say that in order to find opportunities, they don't necessarily fall in your lap. Sometimes they do. Actually, if you meet someone at the right spot at the right time, opportunistically, those deals happen. But it's relatively rare. And if you start to think about acquiring a firm, the process of researching those companies, to reach out to them, get them on a discussions going, to understand their financials, to provide a indication of interest or a letter of intent, and to do diligence and to do a quality of earnings and then get through agreements. There's a there's a lot that goes on in this process, Mike. So I'm curious, why do firms, when you started to look at this M&A market and the amount of work that it takes to actually get a deal done, why do companies start to look at and hire a buy-side advisor instead of just sourcing deals by yourself? What's the real value of starting to bring in a firm that can help you with your M&A initiatives?
Well, I think there's a lot of reasons why that works pretty well, Ryan. Is first of all, I've often said M&A is the most unnatural act in business. It's certainly something that most operators or even a lot of private equity guys don't have a tremendous amount of experience. At least they don't have as much experience as likely an M&A advisor, for example, someone that does this for a living. And experience matters, right? On how to do research, how to target firms, how to open discussions with outreach, how to qualify them as a potential seller for a particular opportunity, how to get them to the table, and then how to chart a course as a 1 + 1 = 3. And that's all beyond sort of the mechanics of valuing that firm, making an offer, and ultimately doing diligence on that firm. And so I think, oftentimes when people think of M&A advisors or buy-side advisors, they think about them just adding value in origination, because it's really hard to call up a business owner and say, hey, have you ever thought about selling your business? And then convince them to get to a table and close, right? It's a very challenging thing to do. And you have to have a well-oiled machine that can do that. And unless you have people that have done that day in and day out for years, it's challenging for you as a business operator or as a leader in a company, or even as someone who leads corporate development for a firm, to have the scale and have exercised the muscle enough to be effective at doing that. It takes many, many, many touches on multi-channel to get someone to have that conversation. And unless you've got a program that is nimble and you've figured it out, you're going to be at this a long time. And so I think, the smartest operators, private equity firms, sponsors, work with specialists like Revenue Rocket to do that, right? They see the value in a niche market specialist like we are in IT services, and leveraging our domain expertise, our contacts, our Rolodex, and more importantly, our process that's proven, and in our case, been proven over 25 years, along with our team and our people that do this for a living, to get those results faster. Now, certainly you can do it on your own, but it's going to take a lot longer with a lot more mistakes and misses than if you hire a firm who does this for a living. And it just comes back to, do you have the tools and the talent and the experience at the ready? And if you do, I'd say, great, knock yourself out and do it on your own. But my bet is you're going to get better results with someone who does this every day and has done it for a long time.
I'm in the business, so I tend to agree with you. It's one of those cases in which, even if I look at our own firm, you have to have specialties within your function. And it's really hard to be the guy who can do a due diligence report and also being able to crack open a brand new conversation, convincing someone to sell their life work who's never engaged in a conversation like this before. So the specialty is large, paired with the just the horsepower that another firm can have. So bringing that forthright, or bringing that to the front is a big deal. And then also, to your point, Mike, I think you nailed it. There's a large component of the deals are much bigger than just starting out and sourcing. Everything from the valuation from a third party perspective in which where someone with industry expertise has actually seen deals. It's really hard as an operator to see those kind of to see the multiples that we see, frankly, or the deal structures that we see, or the conversations that we have with real buyers and real sellers, not just spreadsheets or reports from third-party sites. I think that's a big difference in the access to knowledge and the capability of executing upon that. You talked about some of the risks of doing this alone. And Mike, I mean, what other things happen? It seems like deal fatigue can be huge and distractions of doing this, or just simply overpaying because you may not know the true value of the firm. Or even strategically aligning, you might be too close to this emotionally, and it's hard to take a step back and say, what is this to be done strategically? But what are other risks that CEOs or business development people start to encounter when they do this alone and take a run at buying companies by themselves?
Well, there's a long list, Ryan. Certainly, you have to have the technical skills to do each one of these very specific jobs well. Like, you need to be an expert researcher. You need to have expert outreach skills to be able to call people, to cold call people, or cold email, or cold target them in a compelling way to get them to a conversation. And then when you get them to the conversation, you need to be able to engage them in a conversation about them, because it is much more about what they're trying to build and what they're trying to do in support of an eventual exit. And that eventual exit might not be now, and it might not be with you. So being able to have a conversation about, kind of what's in it for them, and then be able to move them along to engage on doing evaluation where you have great expertise in that, as well as, diligence and working with lawyers to do drafting and all that stuff, requires a lot of very specific knowledge and skill sets that pretty hard for one individual to be an expert in all of those things. And so what happens is, if you're not an expert in all of those things, you tend to make mistakes. And you tend to make mistakes at critical times in the process that can put deals at risk. And that's part of why there's a lot of statistics that say if you're going to roll your own in an M&A deal, there's only about a 1% chance you're going to get that done. And so that means that there's all these inflection points where typically people that try to roll their own make mistakes or can't execute. That's why those numbers are low. Industry stats, when you use an advisor, those numbers go up pretty dramatically to about 50%. So, that vast crevasse between 1 and 50% has to do, I think, in many ways about using experts in all these different areas of domain within buy side that can help you move things along with the knowledge and the experience to do it. I think there's also risks for overpaying or getting what I call deal fever. Sometimes people who are buyers get deal fever. They want the deal so bad that they'll do whatever they need to do to get it over the line. And that causes them to overpay or to acquiesce on deal terms. They get emotionally connected to the deal because they've invested so much time and energy and money in some cases with legal and other third parties that they just want it done. They just want it over with. And you need someone who's emotionally detached to be able to help keep you in your lane as it relates to the negotiation. And not to mention that there's great value in having a third party help you just maintain the relationship with a seller. As we've often said, that, oftentimes there's stink left on someone in a transaction because these negotiations are hard and long and tedious. And it's better to have that person be a third party M&A advisor than you, because you have to maintain a relationship with someone you're going to work with in the future. And you don't want them carrying a chip on their shoulder about something you might have said along the way in the process. And so, there's certainly risks, a lot more risk, I think, for failure if you try to roll your own than not. And that alone, for smart buyers who engage buy-side advisors, they get that, right? They understand that this is a risk mitigation strategy. This is a way for us to go from 1% to 50% chance of getting the deal done. It's a way for us to leverage our limited resources in a much more effective way. And those guys engage firms like Revenue Rocket to do buy side all the time.
Yeah. And it's the next question I have really, Mike, is exactly when. So when should a firm engage a buy side uh, advisor like Revenue Rocket or other or companies like us? Uh, is that typically, before you're identified a target? Is it after? When you're trying to buy a platform or an add-in or tuck-in? Kind of when's the best time that you see buy-side initiatives from using a third-party special advisor works well?
Well, I think most operators and actually most sponsors or private equity firms already have a full-time job, right? They're busy. Whether you're a CEO or of a sponsored company or a standalone company you built, or maybe both, you're busy, right? You're already wearing a lot of hats and you're busy. And so in some ways, when you hire an outside firm, you're outsourcing a big part of your corporate development function to an expert, a domain expert in a niche. And from that perspective, the best way to do it is early and often. So once you've determined you're going to grow through acquisition, it's often best to formulate your thinking once you've thought about your target, your ideal target, to engage in a conversation with an M&A advisor about that. Like, what do they see in the market? How available are these types of targets? How much experience have they had in doing deals in the space, et cetera? And then engage them to do sort of the full life cycle of assisting you to get that done. If you try to piecemeal it or try to bring them in later, or you've already identified a target, and now you need to help getting them over the line, you certainly can get value. And we've certainly engaged with many clients farther through the process. But you've probably sub-optimized your process in its entirety by not having a fulsome suite of choices early in the process, and then being able to select the best targets to buy. So, I think understanding that you're augmenting your team, corporate development with a world-class corporate development function that has specialists in all aspects of what's required, obviously it should anyway, net a much better outcome than you would have without those resources. It's like having experts in, 7 different domains in the M&A process, all working for you at the same time. That's a pretty good formula for success. And I would say that the smartest folks out there engage early when they're contemplating acquiring a firm in the space, get advice and counsel from an a proven buy-side M&A advisor with niche domain expertise, and then they engage them to help them through the full journey.
Right. Absolutely. That advisor's alongside with you the entire time. When I think about this and I think about the engagement process and someone's getting ready, they've got to get enough homework to start in a strategy that says M&A is important. And sometimes that's driven by a private equity firm or an investor who's looking to get just more out of their investment. Sometimes the timing, like we've seen, there are investment cycles in which you need to perhaps get over a certain revenue target to meet your objective in selling your firm. So oftentimes we see the case where people build a great asset, but they realize if I could just tack on another 10 million in revenue and 2 million in EBITDA, that I could perhaps meet a different revenue and EBITDA threshold to actually make my investment exponentially more valuable. And so we do see engagement from firms of bringing us in later in a cycle as well to kind of hit that last stage growth, then eventually looking for a recapitalization or another movement into another firm to really maximize those initiatives. Mike, when you think about this, how long does a typical process or buy side process work? From kickoff to close, what kind of what should a firm budget for just understanding the process of utilizing an advisor, and even without advisor, what's the expectations of timing that CEO should think about when looking to buy another firm?
Well, I think sometimes there's some misperceptions in the market that, hey, if I go hire a buy side advisor, they should have all these sellers ready to go. I think that's a false impression of how the market actually works. The reality of the matter is a credible firm that does buy side is going to be one that will help you identify the ideal target for you on a variety of different attributes. And then they'll go find the firms that fit that profile, right? You can't do that if you just quote unquote have companies in the basket for sale, right? It's not one that likely will fit your profile exactly or very closely. And so it is a process. You have to engage in a active outreach campaign to find the ideal target and convince them to come to the table. And so, I often say it takes time. It's hard to predict the future, but I'd say on average, it takes 3 to 6 months to find the target. And then it takes you about 90 days to close from the time you get to LOI. Could take longer, could take less time. It just depends a lot on sort of how the market is now, what the profile you have for a particular target, the size of the addressable market for that target. Is it, oftentimes we use this term, is it overfished? Is it a market that there's been a lot of consolidation already, or is it more of a open market where it's not that way? So there are a lot of variables. I don't want to sugarcoat it in any way. Certainly I think our fastest processes have been, from kickoff to close, 5 months, and our longest have taken over a year. So it just depends on the complexities of the individual mandate. Now, I would tell you success and the spoils go to the patient. People that are patient as you work through this process. It's proven. We know it works. The longer you're in market, the better. There's some really interesting statistics about, it takes 11 plus touches to try to get someone to respond to you. Multi-channel is important. You have to be able to be very targeted in your approach and in your messaging, and your persistence matters. And so that takes time, right? You can't call someone 11 times in one day and expect they're going to pick up the phone. It's more of an art, frankly, than a science. And I think people that do it every day have figured it out. And so I would just say that most successful programs we have on the buy side happen with the folks that are the most patient. They do multiple deals, typically, that fit their profile. They've grown their business more quickly than others through M&A because they're patient about finding the right targets. Because the drumbeat of the outreach and the drumbeat of finding the right targets ultimately does pay off. It just can't pay off in very, very short period of time. It's very unlikely to be paying off in 30 or 60 days. And so I would just encourage all the listeners that are thinking about this that the more patient you are, the higher the likelihood you'll be successful with a buy-side campaign using an advisor, because you can be selective, because you can see more opportunities, and you can move on the ones that are most strategic for you.
Yeah, absolutely. And to your point, I just want to emphasize you really can't contact someone so much in one day. And so oftentimes this is a germinating process. You're going to be planting those seeds grow into bushes and trees, and you're going to at some point harvest the fruit that comes from those trees. But it does take a lot. We've had some cases in which and keep in mind, Revenue Rocket, we're very, very specialized in what we do. So we are working with a relatively small group of people in the IT services space. So they've heard of us. So they've been educated on what it means to be an IT services firm and grow. So hopefully that accelerates, but it's still getting a hold of someone in today's environment, getting them through to actually have the conversation, to think about that. You're really convincing someone to sell their life's work, and that is not easy to do, and to get them a call out of the blue to engage and actually sell takes a bit. And that third party resource can really do things that you as a firm, I think, would struggle to do. Um, Mike, if I was transition here a little bit and I just have a few more questions, but I think they're important. Um, when you look at the advisory mindset, what should someone expect a fee structure to look like? And when they look to a third party, don't have to get necessarily into specifics of how much, but what kind of fee arrangements do third party advisors typically use, and how should a firm evaluate that fee structure versus the value that they're getting out of the work?
Yeah, great question, Ryan. I think most credible buy side advisors charge a retainer plus a success fee. And there's specific reasons for that. I think if they built a firm of scale with the specialists that we've talked about, that's there's quite a bit of investment that's gone into hiring and maintaining and cultivating the skills of those specialists. There's ongoing training and skill development and what we'll just call just good care and feeding for those individual professionals to grow their skills. And you want that. And I think when you pay a retainer, what you can think about is, you're getting that expertise, fractional expertise of all of those people on the team through that retainer. It's a number that's far less than it would cost you to hire those people, even on a part-time basis. And so you're getting quite a bit of leverage by using a firm, an M&A advisory firm like Revenue Rocket, because they have systems and people and process, and you're just, paying a small fraction of what it costs to operate that business and have access to those team members. Your options are hire them all, hire and build the processes and buy all the tools. And certainly when you think about that in the context of the retainer is a small price to pay. The success fee in many ways is certainly part of the fee structure, but it is a way for people to share in the success of getting a deal done. That is a very, very hard thing to do, right? So it is an incentive, if you will, for everyone to move the deal towards the goal line as quickly as possible and ultimately compensate for the full investment that it takes on behalf of that M&A advisor. And so I think the most credible firms do it with a retainer and a success fee. I think it's pretty hard to do it otherwise. You will find contingent buy-side advisors out there, but they're typically not either going to commit the time, energy, and resources needed to be successful, meaning they'll just be passively looking or passively thinking about your mandate. And if they happen to stumble across one, they'll bring it to you, which likely isn't going to net any sort of success in the future. Or they're a very small, low-cost operation that does not have these types of individuals in these roles with the process and tools needed to be successful. So their success rates in either case on a contingent basis are going to be much lower than a firm that is adequately staffed with trained people and tools that you would pay with a retainer and a success fee. So, I know there's a lot of questions around that in the market about, hey, well, there's people that do this on a contingency or just a success fee basis, but I think you have to understand that it's a little bit of a buyer beware. You need to understand what you're actually buying, and you kind of get what you pay for when you begin to look at working with firms that are contingent versus those that typically charge a retainer plus success fee model.
That's great. I think, Mike, we covered a lot of this. We covered the timing and when you want to do this. So if you're looking to accelerate your growth, you have a stable company, you've got a strategy that's in line, or perhaps you're PE funded and you just need maybe that add-on addition. It's a great time to bring on an advisor to really accelerate those efforts. I heard you talk about the making sure that there's strategic, cultural, and financial fit. So there's some readiness components I think that becomes with your firm that your advisor should really help you with. And once they're on board, they can start to engage. I heard that a process can take between 6 and 9 months. It can take, of course, it can be earlier, it can be longer, but in general, being patient throughout the process is critical as we're really trying to convince people to do something that they're not necessarily ready for, but having that pipeline of successful opportunities is what's eventually going to be great for a firm. And I heard to prepare to budget some, but it's probably less than what you're going to pay. And if you're trying to do this full time and by yourself, it's probably a great way to save money. Um, ultimately the advisors that you're working for are looking for success at the end, and a successful transaction is by far the most meaningful metric that you're going to measure in a transaction like this. So, Mike, I'll turn it over to you. Any last comments or thoughts?
No, I just say, I think the fastest growing firms in the market, the ones that are the most successful, combine organic with an inorganic process. They grow and are sort of at the front of the line from their peers as it relates to growth and profitability organically. And then they layer on a very well-run and comprehensive M&A strategy that just accelerates that excellence, if you will. And I think the firms that are, do that the best are ones that are smart enough to know they don't know it all, that they can't necessarily have all the same level of execution talent that's required to get it done quickly and efficiently, and thus they outsource it to an M&A advisor that's already built that with a proven track record. So I'll kind of leave you there. With that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. I encourage you to tune in next time. We'll unpack further stories from the road, if you will, things that we see in the market as an M&A advisor. And I'll leave you with sort of our new tagline here at Revenue Rocket. We are M&A people. Think of us when you need some help if you're an IT services company in the M&A realm. Take care and have a great week.